Hey, what's up, everyone? This is Kirk here again at Option Alpha, and today we are going to talk about adjusting or managing strangles because everyone always wants to know how do you adjust or manage strangles. And hopefully, you guys might like my new little whiteboard instead of doing on paper and Sharpie, which got really, I guess, not expensive, but I was just blowing through a lot of paper. Now I have this sweet new whiteboard to use, which I'll use for you guys here today. So here's the thing, right? So when you do a strangle, I want to talk in two stages, really. So the first thing that we're going to talk about is just logistically how it looks when you're actually trading the stock. So here's the stock, right? The stock is moving, etc. And let's say at this point right here, you enter into a strangle. So you sell a call option that's above the market, and you sell a put option that's below the market. So the whole idea with a strangle is that you're forcing the stock to make a move inside of this range, usually about a 70% chance of success that it moves somewhere in between this range, right? And so when you sell the call and you sell the put, you're hoping that the stock lands somewhere in this range. Well, obviously something's going to happen to where the stock doesn't do that and kind of moves against your position, right? So I'm going to use this to now erase this a little bit. And now let's say that the stock starts to move up against your position, starts to bypass your call short strike. So I'll just re-erase this so you can see. But let's say your call strike is out here, right? And now the stock is making a huge run up and is on the way towards bypassing your call strike or breaching your short call strike. Now, what a lot of people will teach you to do, and I think this is a wrong way to do it, is that they will teach you to move your tested or challenged side higher. So let me just actually slide this down so you can see it for a second. They'll teach you to move this challenge or tested side higher. And what they'll say is close this out and reestablish a new position higher up, right? To give yourself more room. And I get the logic behind that. The problem is let's say that you enter this original call, let's say for $1, you enter the original put for $1, so $2 overall. Well, now that this thing is being challenged, this thing might actually be worth like $3, right? So now you are 100% taking that $2 loss as, I guess, against your position because you're closing this out and trying to reestablish it higher. The problem with doing this, though, is that what if the stock continues to move higher, right? You're just literally digging yourself into a hole further and further and further. And by doing this, you basically end up compounding the loss on top of itself because now you sell this one for $3, right, or something, and now you buy it back for $5. And then it keeps going higher, and now you sell this one for $5, and you buy it back for $7, right? And you guys see how this can happen, right? Like, you just keeps going up and up and up and up and up. So here's what I say you do instead. And this is, I guess, the difference between us and a lot of people. And we've been talking about this for years. This is nothing new. We've actually been talking about this for about 6 years publicly on the website now about how you do this. If you have, let's say, a call option and the stock starts going against your call option short strike, okay, somewhere up here. And again, you sold this option for, let's say, $1, so you've got $2 overall in premium. What you actually want to do is take your put strike and you want to move this baby up and you want to move it closer to where the stock is going. So you move up the unchallenged or untested side. So in this case, if the stock is running away, your original put that you sold for $1 might be worth, in most cases, I don't know, 10 cents, right? So now for sure, you're banking a $90 profit on this leg and then reestablishing this for, let's say, another $1, right? Now, of course, you're starting to lose on this side, so you start to lose on this side, right, where, it's being challenged, but you're not moving this side up. You're not compounding the loss on the top side. So you take whatever happens up here and you basically leave this position alone. You don't move it, don't challenge it, or don't roll it up, even if it gets tested, even if it blows through your strike. We're just going to keep moving our put strike higher and higher and higher until the point at which we are basically at a straddle. So we basically can move this all the way up. We can adjust it, however many times it takes, sometimes 2 or 3 times. We've adjusted them 4 times if we get them really, really wide in the beginning. And we just keep collecting more dollars every time, right? So another $1, another $1, another $1. And then every time we close it out, it's worth, 10 cents and then 10 cents and then 10 cents. And we just keep adding to this premium. We collect dollars and dollars and dollars. The beautiful thing about doing this, let me just erase this for a second here, okay? So you guys can see the logic behind doing it this way, is that when you do this type of position and your initial position is, let's say, $2 a premium, let's say that the stock is at $50 and you sell a 55 strike call option, okay? So this is the call option. Again, we're assuming that the stock is challenging just one side of your trade. By our initial position having a $2 credit, our break-even point is actually up around $57, right? Because we have that $2 credit that gets added to the strike price. So our break-even's up around $57. Well, when we start rolling up our put side, let's say we roll up our put side to, from let's say 45 initially. Hopefully you guys can see this on the screen, but let's say 45 initially to, I don't know, let's say $48, something like that. We might take in an extra $1 of credit, right? In addition to the money that we profited. So now our total credit is now not $2, but $3. So by doing this, we're moving up our put side. We're basically taking what the market gives us. They've given us an opportunity to make money on this side, right? We're not moving the side that's challenged, but now our break-even point is not 57, but 58. So even by doing this, by naturally just moving up this side, we are extending our break-even point further and further up as we roll up our unchallenged side. So even though it doesn't feel like we're doing anything to the side, even though we're not giving it any attention, our break-even point is moving further and further and further out. And in some cases, we've been able to double, triple the credit that we receive by just making these adjustments, okay? Now, the last reason that we do it like this is because, look, markets are cyclical, guys, right? That's why we do this, so that when a stock does this, it's never going to do that forever. And so by continuously leaving that call side right there and moving that put side up from somewhere, let's say down here, so here's our original put, here's our new put option, right? We have a really tight strangle or a tight straddle. We give ourselves an opportunity that if the stock were to just even momentarily fall back inside of our range for a couple days, it gives us an opportunity to close the whole daggone thing for a profit, right? So that's why we do this. We don't want to shoot ourselves in the foot by moving this call side up. Take what the market gives you and move up your put side when you get challenged higher, okay? That's exactly what we want to do. So said in the reverse, just to make sure everyone's totally clear on this and how we do it. And you can add a comment in here. In fact, everyone who's on here right now, let's say we get challenged to the bottom side. Let's say we enter a trade here. We sell a call. We sell a put down below the market. Now, if the market starts to tank, right, starts moving really, really far down against our position, what do we do? Let me know in the comment section real quick if you could. I love doing these live videos. What do we do? So do we move down the put side or do we move down the call side? See if anybody answers. It's like that awkward moment of pause, or hopefully you get what it is. Okay, so no one's answering. No one's being brave enough to answer. All right, so the answer obviously is you move down the call side, right? You would close out this call spread. Thank you, Stefan. You'd move down the call side, and then you would reestablish a new call spread lower for a credit, right? So the difference between closing and opening is going to be a net credit. You're going to buy this one back for less money than you sold it. That puts money in your pocket, in your bank, and then you sell another one closer for a higher premium, and you still take in a net credit difference. And again, that net credit pads the overall premium that you received on the whole trade. So it just keeps moving the break-even point lower on the put side by that initial premium. So if you take in, let's say, $1.50 of net credit by rolling down your call side, well, boom, that's where your break-even point moves a little bit further down. It moves down another $1.50, okay? So does that make sense how we're doing it? This is the entire strategy around making adjustments to strangles and straddles, etc. Now, I'll link up once this live video is done, or if you're watching this recorded, you'll see this already in there. I'll link up a couple videos where we actually do this live on screen. So you just want to go ahead and obviously look at some of the links that are probably right above you here inside of the actual comment box, or at least by now, by the time you're watching this video. I'll also link up a huge tutorial that we do on adjustments so you can see multiple examples of real trades where we're doing this. But hopefully this concept makes sense. Hopefully this helps out. I know you get a lot of questions on adjusting strangles. Again, if you guys like this, give me the thumbs up real quick, the hearts, etc., just to make sure that I know I'm on pace with you guys. And of course, if you guys have any other questions, add them in the comment section. I'll make sure I get to these just as soon as I'm able. And until next time, happy trading.